It's now time for our technical session 1, that is on understanding of GSTR 9C by CA Madhur Harlalka. By CA Madhur Harlalka. And I request Managing Committee Member Swarna Lata ma'am to escort sir onto the dais. And welcome him with a bouquet. CA Madhur Harlalka is a partner at Walker Chandyak and Company LLP, Chartered Accountants. Madhur has 17 years of experience in the field of indirect taxes and business advisory. He qualified as a Chartered Accountant in 2002. He is also a graduate in law. He has been closely associated with well-known corporates across the globe, including India. He is based out of Bangalore and heads GST practice of the firm for Bengaluru and Hyderabad markets. He specializes in indirect taxes such as GST, service tax, VAT, entry tax, customs, central excise and regulatory matters such as foreign trade policy and SEZ. He has been rendering indirect tax advisory, compliance, refund, audit and litigation services for Indian and global corporates. He has rendered indirect tax services in wide-ranging sectors such as IT, IDES, manufacturing, EPC, trading, e-commerce, sports, healthcare, startups, banking, media, logistics, consumer goods, F&B, real estate, etc. Madhur is actively involved with Indian trade and professional bodies for understanding GST policy initiatives with the Indian government. He has also authored for well-known professional journals and publications on indirect taxes. He is also an active speaker and faculty on GST matters for events and the courses organized by trade and professional bodies. Prior to merging his firm with Walker Chandyak and Company in 2016, he was one of the founding partners of Rishi Madhur and Company, Chartered Accountants in 2003, a Bengaluru-based firm providing services in the areas of corporate accounting, tax, auditing, and advisory. It's a privilege to have you on the dais, sir. May I request you to conduct the session?
It's my sheer privilege to be part of Bangalore branch and share my thoughts on GST audit form 9C, which is the audited statement or the reconciliation statement. It's always a pleasure, no doubt, and stalwarts like Dr. B.V. Murali Krishna, I've known him from a long time, and I've been associated with the C Institute last 20 years, and Chairman Shri Bhatt, he was speaking about the Institute classes and the platform. I can only, without spending much time, I will totally agree with him. Because way back in 2000-2001 when I was a student before qualifying, I remember this very same hall, we used to come study here, attend classes. The quality of institute classes that time itself were very good. Now obviously it has jumped 4 more times, so that was almost 18 to 20 years back. For us the C Institute, especially Bangalore branch, has been a second home because outside the office hours we used to spend the most time studying here and we have cleared. And it is always great to address the student community. I've been part of a lot of student initiatives in the Bangalore branch like GMCS and practice development, practice management and things like that. So it is my sheer honor and I thank each one of you, for spending your valuable time on a weekend. I know it is exam time for some of you. I think CA final is there, IPCC exams are there. Some of these exams have got postponed due to the elections and things like that. So all of us here present, I myself, it remembers me of my student days in the first year or the second year or the third year of my articleship, or just when I was a freshly qualified chartered accountant student. Let me tell you what Chairman Sir has said, that two, three things. One is, the most important thing is you have to have passion in life. Whatever you want to do tomorrow, audit, income tax, indirect taxes or advisory, or you want to do your own business or a startup, you have to have that fire in your belly. I think without that passion, you cannot first of all clear the exams. And having cleared the exams, then you want to chase your dreams. So the only message I will give to all the students here is, don't think about your, what you will do after qualifying, which field you want to take. Single-mindedly just focus on the CA final or the CA IPCC exams, because at this point in time for you, it is the most important thing in the world, So those are the things which, it is really good, because the same things, the same thoughts, the institute classes, having the passion and the fire in the belly, it reminds me of my own student days. And nothing is impossible if you are willing to work hard, you have the passion, you are dedicated, and you are honest and sincere to yourself, And don't think that you are a student, you are young, it is a very long road. Let me tell you, there is no time once you qualify. When you look back, a lot of time would have elapsed. For me, it is 17, 18 years post-qualification in this. But today, every morning, I still have the curiosity of a CA student when I sit down and advise my clients on indirect taxes. Because from 2002 till now, last 17 years, I have been practicing ITD. By God's grace, I still have that passion to serve my clients in the field of indirect taxes. And I am under no doubt that each one of you should follow that same thing, whether audit or tax or advisory or any other subject. So that is again very, very important. So the curiosity of a student is the most important thing. Even we experienced professionals, we have to be very, very curiosity oriented and not think that, okay, I'm 18 years and I know it all. The law is very, very new. Yes, we only have the advantage that we have more years of experience as far as the earlier indirect tax laws are concerned. But today I tell the same thing in my office to my students. Please read. Dr. B.V. Murali Krishna said, please read. No ready reckoner, no textbook when you are doing work in the office. See, the way you approach exam is different from what you work in the office during articleship 10 to 6 or 9 to 5. Right? So when you are filling up any GSTR return, please make sure you are aware of all the statutory provisions. You should not be merely doing a clerical work of filling up GSTR 1 or 3B or 9 or 9A or 9C. Each and every box, you should know why are you filling it up, what is the statutory provision behind it. That is very, very important. Otherwise, you cannot do the GST audit at all. Because for you to do the GST audit, first you should know what the GST returns are. When you are filling up the monthly GST returns, please make it a habit to read. I mean, even at student level, even in my own office, I will encourage everybody to read the Act, rules, notifications. Some of them are dense. Read those provisions and circulars and notifications which are directly relevant for your day-to-day work. With this background, I will straight away start with, what are the relevant statutory provisions behind GST audit. Now, in the next 1.5 hours, and Chandrasekhar is also there, so I will try to make sure, we are a bit behind schedule, 20-30 minutes. I will try to, make it as simple as possible from a student perspective, and he will continue the further topic, maybe, what are the further issues in 9C. Here I will give you an overview of the background of the statutory, the GST audit provisions, why it is applicable, and how do you fill up this 9C clause by clause, and what are the possible issues. These are some of the initial issues. They are not all. Maybe you speak to 10 people, there may be 10 more people, there are 10 more issues. I may have a view, some other people may on the same matter may have a different view. Right? So basically, I'll just skip slides. So what are the statutory provisions? If you look at the bottom of this slide, section 35(5), read with rule 83. Now when you are doing GST audit, you may not be specializing in indirect taxes. Maybe some of you are part of the statutory audit team or internal audit team. But if your statutory audit team or internal audit team is involving you for GST audit, you make sure to tell your audit managers, please give me the manuscript. I would like to know the basics of the GST audit as to what is GST, what is goods, what is services, what is input tax, what is output tax, right? Those basic things, input services, capital goods, and the most important thing is what are the statutory provisions. So which are the statutory provisions? Section 35(5), read with rule 83, where every registered person whose aggregate turnover during a financial year exceeds INR 2 crores shall get his accounts audited either by a chartered accountant or a cost accountant. Now if you just look back the pre-GST days, the only compulsory audit was the VAT audit all over India, and in Karnataka VAT, it was VAT 240. Nowhere in central excise and customs and service tax law, there was a compulsory or a statutorily required audit to be done. Of course, there was a departmental audit for excise, customs and service tax, which obviously used to happen. But there was no mandatory audit apart from the VAT law. And obviously there are mandatory audits under Companies Act and under the Income Tax Act. So as far as the VAT law is concerned, we have very rich experience in the last 10 to 15 years from 2005 of doing the compulsory VAT audit at the state level, but that is mainly for goods. Now, as we all know, goods and services both have been combined. So this 2 crore limit, okay, now this 2 crore limit has to be for all India. Now GST again a very, very unique law in the sense that you may be PAN income tax related one entity all India, but if you have 10 branches, every state is a different registered entity. Every GST number is a separate legal entity. So inter-branch transactions are taxable under GST, which under VAT, okay, they were not taxable. Stock transfer was not taxable. There was no question of service tax being rendered from one state to another because service tax was one all India law. It was a central law. So to that extent, there is a very, very paradigm shift in, first of all, understanding what this GST audit is state-wise. The only state-wise audit, as I told you, we have done earlier is the state-wise VAT audit. We have never done, and obviously the excise audit used to be also factory-wise. Wherever your factory is, the excise and service tax authorities will come and audit you. Now this is the first time all these goods and services have been combined, and central excise, service tax, VAT, all have been combined, CST, entry tax, and put under GST. Customs, there are audits which will happen, on-site post-clearance audit, there are recent rules which have been notified in the last year, May. So that will continue because customs is a separate law, it is outside GST, only the IGST is interlinked between GST and customs. Right. So customs, whatever the audit provisions are there, the departmental audit, it was there pre-GST, it will keep continuing, and it is a parallel indirect tax law even after the introduction of GST. So this is the main statutory provision, exceeds 2 crores. Okay. Now this aggregate turnover, this is read with Rule 80 sub Rule 3. What the 35.5 says is prescribed, and Rule 80 sub Rule 3, what is the prescribed turnover is the aggregate turnover if it exceeds 2 crores. Right. Now this 2 crores is, if individually also, each state in India it is let's say 20 lakh turnover, and if all India you have 10 states, if it is 2 crore, if that all India turnover exceeds 2 crores, even then you are liable to compulsory audit for each state, even though for every state the turnover may not exceed 2 crore. So this 2 crore is on a pan-India basis. Assuming you have more than one state, assuming you have only single PAN and a one GST number, let's say in the state of Karnataka, obviously you have to evaluate this 2 crore for only that particular GST number because you don't have any other GST number. So again, and as Dr. B.V. Murali Krishna said, there are no exceptions for this. Any registered person, if his all India turnover is more than 2 crores, GST audit is compulsory. That is very, very important. Now if you look at section 44.1 and 44.2, one sec, sorry, before going there, I'll just step back. What is the meaning of aggregate turnover and what is the meaning of the term audit? I think these are the two very important definitions. Now aggregate turnover would mean all India PAN based turnover for the financial year. Now this financial year is again a bit of a misnomer. We are talking about 17-18. So this 2 crore, there are again two schools of thought whether it is for the entire financial year or only from July to March. Because GST was introduced on 1st July 2017. So when you say financial year, my understanding is the financial year pertaining to those 9 months for which the GST law was applicable. So you have to evaluate this 2 crores for the 9-month period, and according to me the 3-month period you have to leave it because those 3 months, April to June 30th 2017, the GST law itself was not applicable. Legally it came into force only on 1st July 2017. So mind you, the first quarter, wherever applicable, the VAT audits will be applicable subject to the threshold for each particular state. Now, what is the meaning of aggregate turnover? It includes all supplies, whether it is local, interstate, imports, exports, exempt supplies also. Now, there is a definition of exempt supply. It includes all nil-rated, generally exempt, and non-leviable. So, let's say you are selling alcohol or petrol, both which are, so alcohol is outside GST, petrol is within GST but yet to be notified. Okay, immovable property. So, you have to take all the GST turnover, whether it is liable to GST or not liable to GST, for you to calculate the 2 crore criteria. The only turnover which you don't have to include is the reverse charge, on which you are paying the reverse charge. That turnover you don't have to include. So that is very, very important. And obviously excluding GST and cess. Now this definition of the term audit also is extremely important. Section 2 subsection 13. Audit means examination of records, returns and other documents maintained or furnished by the registered person under the GST Act and the rules for us to verify, now see this bold, correctness of turnover, the taxes paid and the input tax credit claim, and to assess his compliance with the same as in with the provisions of the GST law. So this is very, very important. See, net in GST, what is there? Let us just understand. There is sales, there will be an output tax. There will be purchase, there will be an input tax. You use the input tax to set off against output tax, and if there is any balance still to be paid, you pay it in cash. Right? So what the government basically wants is you have reported all your sales, you have paid the tax at the correct rate on the correct value, and you have claimed all the correct purchases on input credit. That is what the scope and ambit of the audit is. It is nothing but sales, purchase, output tax and input tax. And output tax operates hand in hand with input tax. Any exemption on output tax or any exemption on sales will have an immediate impact on input tax credit. So in fact both, you cannot rule out. So sometimes we feel we are very happy we are exempt and all. But the moment you are exempt like medical or healthcare or any other item, your input tax credit starts getting reversed, which affects your bottom line, which means the cost of rendering those supplies or services only increases. So special attention has to be paid not only on discharging the output liability, what all input credits you are claiming, state-wise, state GST, central GST, IGST, you have to maintain it state-wise. So this is what the scope is. Now when you come to 44.1 and 44.2, there is an annual return which is prescribed except for these four categories. We spoke about it earlier. ISD, casual person, non-taxable resident person, and TDS and TCS people. Apart from that, every other person has to file an annual return. Now let us understand this annual return does not have any turnover threshold. There is no, unlike audit, which is a 2 crore threshold, annual return does not have a turnover threshold. So every registered person other than these four categories have to file an annual return by 31st of December. Now obviously the due date is postponed to 30th June. So you have two obligations after the year end. Okay, so every month we are filing GSTR 1 and 3B returns. After the year end, you will form a annual return in 9 and 9 capital years when you are a composition dealer. Once you file the annual return or having filled up the annual return, then you choose to do the annual return reconciliation state-wise with the audited balance sheet. Now when I come to reconciliation, in my 20-year-old career, I have not seen an audit provision where I have to, whenever returns we file or whatever audit you do, invariably it has to tie up with your audited GL. But that is not the format in which we used to report. If you look at the VAT 240, I don't know how many of us here have had a chance to do the VAT 240, which is the VAT audit under the Karnataka VAT Act, which is applicable even for the 17-18 for part of the year. Nowhere we have to report reconciliation with the audited balance sheet. We have to just see and report, okay, what is the output tax and input tax and ineligible tax and paid or eligible by the SSE as per the returns and as per the audit, and just report the summary of differences. You are not supposed to make any observation that you are advised to pay, unlike 9C. So it is a very paradigm shift in what you are first of all going to report. See, the way you conduct audit, whether you are going to conduct the audit or not, these statutory provisions will determine. The way you are going to conduct the audit is depending upon what you have to report to the government or to the regulatory authorities. We never said anything is true, correct. I think it was true, correct and complete if you look at the VAT 240. But you never had to reconcile in any of the VAT audit reports or service tax or central excise or income tax line item wise sales and purchase. Now which is what this 9C is telling you to do, and that too for every state, that too for the period of 9 months. So in 17-18 we generally conduct statutory audit for full year, right, and on an all India basis. Here you have to maybe conduct potentially 2 statutory audits, or you have to do 2 hard close, if not 2 statutory audits. You have to finalize your accounts on 30th June 2017 to know which are the closing balances, let's say of input tax credits under the old laws, output tax payable, and what are the transitional credits you are going to transition from old law to the GST law on 1st July 2017. Extremely important. So in my view, you have to have 2 set of audited accounts. One is the first quarter, one is the next 9 months, state-wise. This is the most important feature of this particular law. Mind you, and I will repeat, the VAT law was state-wise, but you never had to statutorily report line item-wise sales and expense reconciliation. Here, the task is huge on the SSE. As things stand today, none of the companies, at least where we are involved, have even finalized any of the annual returns or the reconciliation statement. That is a practical ground level reality. As I am talking to you, maybe some returns are getting finalized. Our team is sitting and doing it, and that is the annual return. So annual return, as the doctor said, if whatever mistakes you have done, you report the actual figures in Form 9. You cannot claim any additional input tax credit, obviously. Whatever the rectified entries in the GL, audited GL, it has to find a place in the Form 9. Extremely important. Today is 11th May. We are what? Less than 50 days away from the due date. There is a good chance again this due date might postpone. We don't know. We'll have to see. There are a lot of wrongs doing that. The format of the audit report may be changed. It being the first year, just a summary audit report, the chartered accountant or the first accountant will have to sign. We don't know. As Dr. B.V. Murali Krishna said, be ready. Law is there, the form is there, you have to comply. The government has given you 2 quarters of extension, first in March and now it is June. But still today, unfortunately, for reasons, maybe they are right in their own way because they are also so busy, maybe manpower is an issue for a lot of companies. Very few companies are, as of today, ready with 9 and 9C. Maybe 9, yes, they are ready, a lot of companies, but 9C, I doubt how much I am aware of the entire industry. 9C, not many people are ready as of today. So you have to file the annual return. And 44.2 what it says is every registered person who is required to get his accounts audited shall furnish a copy of audited annual accounts with the reconciliation statement. So this is again very, very important. Along with this reconciliation statement, see what they are saying is this 9C is not an audit report, it is a reconciliation statement. So again there is a confusion when we are going to clients. They are thinking we are just going to give them a bank reconciliation statement type. But if you look at 9C, the part 1, part 2, the later, there is a proper audit opinion which the auditor has to give. That in my view, I have audited books of accounts, all the relevant records are made available to me. Okay, you have complied with all the provisions of the law. I have to get into the detailed position checking of what all positions you have taken as far as your GST, whether a transaction is liable, not liable, valuation is done properly, you have paid taxes at the correct rate, you have claimed correct inputs, credits, all that I have to verify and report. There are certain areas definitely which we will speak. So it is a full-fledged audit, it is a full-fledged audit report. You may call it a reconciliation statement, but that does not whittle down the scope and the ambit of the scope of the audit. So we have to be very, very clear. Because what you are going to do, as I said, it will determine. So please read each and every word of that 9C at the end. What I have to report as an auditor. And when you are doing any area, please ask your audit manager or your audit partner, what is it that we are trying to achieve here? By checking this particular area, which will help us in finally reporting the statutory requirement under 9C. So 9A, 9B, 9C is there. Now, what does this 9C consist of? 9C consists of a reconciliation statement and a certification prepared after carrying out necessary examination of the accounts, GST returns and records to verify the correctness of turnover disclosed, ITC claim, input tax credit claim, taxes paid and refunds claim and refunds. So basically if you have claimed any GST refunds, the auditor has to check how genuine your refund claims are. To assess compliance under the provisions of the GST Act and applicable rules under. So 9C has really 2 parts. The part A is the reconciliation statement. The part B is the actual certification by the auditor. Now you may call it certification, according to me it is a full-fledged report along with observation, comments, qualification, disclaimer of opinion, matter of emphasis, everything. So what does that mean? As a GST auditor, you also have to have a background of the accounting and audit standards prescribed by the institute or as recommended by the government or the regulatory authority. Some basic audit background always helps while before doing the GST audit. So an overall view of the the accounting or at least the audit standards is a must. How do you conduct what type of audits? And the CA Institute's code of conduct for an auditor, who can be an auditor, who can be a practicing CA, certificate of practice, code of conduct, those basic things we must all know before we even touch any GST audit file. So that knowledge of the CA Institute, CA Act, right, and the auditing standards and accounting standards, the basic working knowledge, I think it's very, very important. And if you have already done some statutory audits, okay, that will definitely, that experience of audit will help you in conducting the GST audit. Very, very important. So in part A, the reconciliation statement, the basic details, under part A there is part 1, 2, 3, 4. Part 1 is basic details about the SSE, his name, contact details and the GST number. The part 2 is the reconciliation of gross turnover. I will come with a line item wise explanation of this. This covers the reconciliation of turnover declared in the audited annual financial statement with turnover declared in 9 GST and wise. So now this is very, very important. This has never been attempted in the history of Indian tax law. That you have to report statutorily, not see as I again tell audit, tax audit, VAT audit, finally whatever audit you do at the back end your workings have to tie up. But you never have to report in that format. Now the reporting has to be done in that format, which means it is very, very foolproof. There is no scope for evasion here. Or if there is any evasion or mismatch, it will immediately throw. That is the idea. Then part 3 is the reconciliation of the tax paid. Once you finalize the audit and the turnover as per the auditor and the turnover as per the SSE, whatever the difference in turnover is, and based on that, whatever is the difference in tax payable as per the SSE and as per the auditor, that you have to report. Part 4, reconciliation of input tax credit. Extremely important. See, every rupee of input tax credit you avail and utilize. Okay, it is a revenue, it is a bottom line issue for the SSE, and it is a revenue, 1 rupee less revenue for the government. Right? So, government will very closely look at each and every input tax credit what you have availed. I mean, there are more than so many conditions to avail and utilize the input tax credit for goods and services, and there are a lot of issues here. So, how you are so vigilant to pay the taxes, you have to be that much more vigilant that you have claimed the correct input tax credit. And even after claiming, if somebody from the crowd asks, sir, I have claimed, but 2A is not uploaded. Can I as an auditor disallow that? We will have to come to that and we will have to arrive at a solution. As of today, there are no clear-cut answers. There are different people who are taking a different view. Anyway, so part 4 is reconciliation of ITC. Basically, each and every line item of expense as per my audited P&L for every state. And on that, whatever input tax has been suffered, what is the eligible part, what is the ineligible part, and the total of eligible, how much I have claimed it in the annual return. Extremely important. Again, so this is one of the most important areas of the 9C. Now, if you come to part 5, auditor's recommendation on additional liability due to non-reconciliation. This covers auditor's recommendation on the additional liability due to non-reconciliation of turnover. Now, this is just a recommendation. There are issues that if I as an auditor recommend, subject to the client agreeing, okay, I can disclose, you have to pay 10 lakhs. Can I file the return or can I file the GST audit report without paying that? Do I have an option not to pay that and yet upload the 9C? It appears from the instructions behind 9C that the SSE has an option to pay the GST as recommended by the auditor in DRC 3. But you are not duty bound, you can still upload the 9C. Whether the system allows it or no, we will have to see that. Mostly the system should allow because clearly the form itself says it is recommendation and the SSE has an option. So if the SSE does not agree or if he agrees but if he is having cash flow issues, he will say, boss, fine, thank you, I will upload, whenever I feel I will pay. Fine, as an auditor what you have to tell him, whenever you pay, there is a high chance, the more you do delay, the interest meter will keep ticking. So by and large, if you don't want to litigate any position due to additional tax identified, basically what the government wants to know, you have reported all your turnover correctly, you have paid the tax correctly and correct input tax credit has been claimed. Okay, but it is not that easy. You know, you just imagine a big multinational company which is having 10 offices all over India, there are all sorts of transactions, there is no clarity on a lot of issues. We will come to some of the issues like, you know, there is a Columbia Asia judgment which is the Karnataka based advance ruling. Okay, what to do on those issues, you know, so it is not that easy to arrive at a conclusion which is even agreeable to the client or to the auditee. As an auditor, I may feel 10 things. But whether is the auditee agreeable, not agreeable due to 10,000 reasons, we will look at that. So again, this part 5 of auditor's recommendation is very important. What should auditor recommend? How much he should recommend? What should be his tone and tenor of recommendation? That is very important. Now, verification statement. This has been inserted on the registered declaration by the registered person. I hereby solemnly confirm and declare that I am uploading and prepared duly signed by the auditor and nothing has been tampered with or altered by me. See, these are very strong words that nothing has been tampered by me, which means the government wants, so there is an appears to be an inherent element of mistrust between the government and the businessman. He is making you sign a declaration by saying that I have not hidden or tampered or changed anything. I am also uploading our other statements as applicable, annual financial statement, balance sheet, P&L, this, that, everything. So again, this verification is extremely important. This has to be given by the SSE. Now there are general notes on 9C. 9C can be only filed after filing of the annual return in form 9C. System does not validate whether the turnover of taxpayer allows, means you can upload 9C, it does not check whether your turnover is 2 crore liable to audit or not. The taxpayer or auditor can download the 9C offline utility file is available recently, say about a month ago, and fill and validate the details in Excel sheet based offline utility. Now I think even annual return utilities come recently, right? Couple of days back. So the chartered accountant or the cost accountant has to use the offline utility to fill up the required details and the certificate. He should then validate and generate the JSON file and upload the file. After generating the JSON file, the auditor shall affix his digital signature. After the auditor signs, the signed JSON file shall be passed on to the taxpayer for the taxpayer to upload the form GSTR 9C No changes are permitted on the signed JSON file. So if an auditor has signed, the taxpayer later cannot sign and change, which is what he is declaring in that verification statement. And system shall validate that no changes have been made by the taxpayer in the JSON file signed by the auditor. So there is a detailed manual released by the department, by the CBIC, on what is the verification and uploading process. Obviously, I will not take this forum to kind of discuss that. What is the procedure for uploading and all. So where the auditor has recommended an additional liability, the taxpayer has an option, quote unquote, to navigate to GSTR, GST DRC3 for making the payment and can navigate back to 9C. The taxpayer has to upload the following PDF, not exceeding 5 MB per file, documents along with the form GSTR 9C and the annual audited accounts. Now, what are the consequences for not conducting the audit and annual return? As doctor said, there is no final return, there is no revised return, there is no concept of revised return. Is there a question of belated return? Yes, in income tax, belated returns cannot be revised. Those are some of the things which we know. In GST, in VAT, none of those issues were there. VAT, you could file, you could file revised return. Service tax, revised returns, you were allowed to file. Excise just recently, 2-3 years back, started after 70 years of excise law. They allowed us to start filing revised returns. Now GST, there is no revised return. Under the GST Amendment Act, there are some enabling provisions which will allow you to file revised return later as may be notified. As of today, no. So for the year of audit 17-18, July 17 to March 18, there is no revision. So if any mistake is there, you have to rectify that mistake in 1 and 3B by March 19 return for which the due date is expired. GSTR 1, the due date was April 11th. GSTR 3B for March 19 was 23rd April. Pertaining to changes you want to disclose pertaining to 17-18. Even after that, if you have some issues or you have not declared the sales turnover correctly in your GSTR 1 or 3B, all those rectification entries you pass in the books of accounts and disclose it in the 9. Very, very important. But in 9, you cannot claim any additional credit which you have not claimed it in the 3B for March 19 pertaining to 17-18. You cannot get a new input tax credit in Form 9. Very, very important. That's one thing. There is no provision for filing a revised Form 9. There is no provision for filing a revised Form 9C. You can file 9 yet delay the audit due to shortage of manpower. You still as a businessman struggling to complete the audit. I think you can do that unless the system again stops you. Because the penalties for not filing the annual return is huge. It is linked to a percentage of your turnover, which is maximum 0.5%. You please imagine a listed company, right? Maybe HLL or an L&T, 0.5% of turnover. If they don't file for one state their annual return, extremely, extremely important. It is 200 per day, CGST plus SGST laws both put together, subject to a maximum of 0.5% turnover in the state or union territory. Non-filing of GSTR 9, there is only a general penalty of 50,000, 25,000, 25,000 each. You can probably live with this penalty. So I see lot of cases shifting beyond 30th June. Lot of cases for 9C, yet 9 may be prepared. So when as an auditor, you have to also see what are the penalties for not filing. I think in VAT 240, the penalty for not filing was I think some VAT of 5,000 rupees under 72, section 72 or 73, if I am not wrong, right? So here the government, according to me, has been quite lenient as far as not doing the audit by 30th June, 50,000 rupees. Okay. So as an auditor, you should know what is the due date, what is the due date for revision of return. Can I file the annual return before the audit date? Can I file the annual return and not file 9C? And if I file 9C, do I have to compulsorily file within whom? Having filed, can I revise it? If I am not sure of filing it, can I delay it by 1 month or 2 months? I am willing to live with the general penalty of 50,000 or 1 lakh as long as I am filing my 9. Even 9 in certain specific circumstances, you can choose to delay it provided you are willing to pay the penalty. And if it does not hit your turnover, percentage of turnover, that penalty should be an acceptable limit. So I think these are all very, very important things when you are going for a cutoff or a initial meeting with your clients. You have to apprise them of all these things. Extremely, extremely important. So this is the statutory provisions as far as the GST audit is concerned. We will take Q&A at the end. I will straight away get on to the clause by clause analysis of 9C. Is it visible here?
Yeah, visible.
Yeah. Is it visible there? Please, last row, you can see. Or do you want me to increase the font size? So the amount column is not important. The particulars column, no, it is very important, this, I will tell you. Yeah. So we'll quickly get on to part 1. This is 9C reconciliation statement. The point under part 1, 1, 2, 3A, 3B, 4. I mean, these are all the basic details. I will not spend much time. One of the most important table is table 5. Now this starts your reconciliation. It is a journey. You start from your audited financials, and if it is state-wise, the reference to audited financials includes the audited GL after the audit entries have been passed. Okay. So turnover including exports as per audited financial statements for the state or union territory for multiple GSTNs under the same PAN shall be derived from the audited annual financial statement. So this will be the starting point. I mean, the right hand side is the amount. I will not really focus on that. Okay, this will be the, let's say this amount is particular for a particular state, it is 100 rupees. Okay, that is the turnover which is disclosed, let's say in your profit and loss account. Okay, obviously all this audited balance sheet and all, the turnover will be disclosed in your audited P&L. Now, are we aware of the concept of unbilled revenue here, please? Even for statutory audit purpose, are we aware of what is the meaning of unbilled revenue? See, these are all slightly technical terminologies when it comes to statutory audit itself. I will tell you, unbilled revenue basically means is, I have booked 100 rupees of turnover as an SSE when my statutory audit, not GST audit, when my statutory audit has happened, due to whatever reason, exchange fluctuation, journal entry, or events happening after the balance sheet date, whatever, my auditor identifies additional sales which had to be booked as on 31st March. But it cannot be billed on 31st March, right? Because I am doing the audit in September. That we are aware, right? Right now. So I go back on 31st March and pass something called an audit entry. What is an audit entry? We are all aware. Each and every audit entry is approved by the auditor and auditee, right? Because it will impact his accounts. Those are the additional audit adjustments which the auditor identifies as part of statutory audit. Okay. So I will go back to the year end and pass certain additional journal entries. It could be expense, it could be income, it could be asset, it could be liability. Only journal entries. Obviously, I cannot go and pass backdated receipts and payment entries because that is real time. Is it not? So unbilled revenue is the additional amount of revenue. I as an auditor will identify. I will pass one journal entry called debit. Debit what? Debtors, credit, unbilled revenue account. Debit debtors, which is my customer account, right? It is the additional sales. So let's take a software company. You have done a cost plus 10% billing. If you have done any software company audit, it is the simplest form of audit, I can tell you. So some cost you have identified, based on that cost plus 15%, but the auditor says no, the cost base is not enough. You have to add 10 other things in the cost. So your cost is increased, and due to which cost plus the margin, your additional turnover. So instead of 100 rupees, he is identified 110 rupees, which means 10 rupees he is disclosed. He is found out additional turnover. So what is the journal entry he passed? Any audit adjustment has to be passed as on 31st March. There are companies which pass 200, 400 entries. I have seen, I myself passed 200 entries as a statutory auditor. Right? So unbilled revenue here means revenue booked which is found out by the auditor but not yet billed. It will get billed after the month of audit. So in September when I finalize my accounts, you will go and pass in your ERP system on 31st March 2018, let's say, and you will do the billing, let's say, in the month of October. So what is the journal entry when I am passing the audit entry? Debit debtors or debit customer account, credit unbilled revenue. Unbilled, revenue booked but not billed. You are not billed it as on 31st March, but I, auditor, identified this after the year end as on 31st March. And for which you will raise a debit note or a tax invoice in the month of, let's say, October. So if I am doing March 18 audit, in October 18 I will raise a note. That time what entry I will pass? I will debit unbilled, I will debit my customer account and credit again the initial debtors account. I will pass on debtors to unbilled revenue. So basically I will just reverse that account. So I have booked my sales. Now I am raising an additional invoice. So that invoice I will actually debit it to my customer account. Extremely important. So basically this revenue would have been identified as a revenue as far as your your P&L is concerned. But it may not have been booked as a revenue in your GST return. So it is an additional turnover which you are supposed to disclose in your annual return. So that is why it is added. Now, unadjusted advances. This is slightly different now, and this unbilled revenue has to be at the beginning of the financial year. Here the financial year is the year of audit, which is 17-18, which is the period 1st July 2017 to 31st March 2018. So maybe your auditor has identified certain unbilled revenue as on 30th June, which means you may have to conduct two audits separately. There are companies who are conducting, there are companies who are not conducting. This is a very, very baseline case. This will be more relevant when you conduct a full-fledged GST audit next year for the entire financial year. So unbilled revenue as on 30th June 2017, booked as a sale but raising a invoice under GST era. Now unadjusted advance at the end of the financial year, that also you have to raise. So unadjusted advance means you have received the money, okay, you have received the money, but it is unadjusted means supply has not taken place. And in GST, you know, there are three taxable events, either rendering or the supply, raising of the invoice or receipt of money. Now receipt of money is towards two things, towards goods and services. For goods, the time of supply was at the time of receipt of money, but 15th November 2017 onwards, that provision was done away with. Which means 15th November onwards, if you receive, or 2017 onwards, if you receive any advance towards supply of goods, it is not taxable at the time of receipt of advance. Only when you bill or supply the goods, it will be taxable. Very, very important, see. So services, no such exception was made. Only services which were exempt is, on which you receive advance, is on exempt services. If it is not taxable, you will not have to report. So unadjusted advances at the end of the financial year. Now this is also to be added to your turnover, which you will report in your annual return. The reason being, you have received the advance, okay? It is not reported as a turnover in your audited financials, but for GST purpose, you would have discharged tax because GST is on accrual or payment, whichever is earlier. So it is a GST turnover, it is not a P&L turnover. And in P&L, if you have not identified this as a turnover, you have to add it. So as Dr. said, see, just view this very, very logically. This plus minus has a logic behind it. And if you understand the logic, you will get it. For understanding that logic, certain basic techniques, what is an unbilled revenue, what is an unadjusted advances, you will have to understand. And please don't do it blindly. If you still don't understand what is unbilled revenue, unfortunately, you know, due to the paucity of time, I can't again speak on this. Please speak to your immediate supervisor or your manager. Please tell me what is unbilled revenue. Extremely, extremely important. Then there is something called a deemed supply. We all know there is a GST Act, there is a Schedule 1 to the Act, where certain supplies without a consideration are deemed to be supply as far as the GST law is concerned. That may or may not have been disclosed in your audited balance sheet. Like for example, stock transfer of goods from Bangalore to Delhi or Bangalore to Mumbai, or rendering of service, inter-branch services, that is never reported as a commercial turnover in your books of accounts. But it may be reported as a GST turnover for your monthly GST report filings. In case you have not recognized that as a turnover, some of these entries will find a place here. Deemed supply. It is deemed to be a supply. Transactions between related person without a consideration. Please read Schedule 1 to the GST Act. It has some 4 or 5 peculiar transactions which otherwise are not turnover, but they are deemed to be turnover. So there is a good chance that this will not be disclosed as a turnover in the ordinary course in the P&L account, which is audited by your statutory auditor. It is only a GST turnover, it is not the turnover as per the normal commercial parlance. Hence it is becoming a subject matter of reconciliation. Now here one important thing is, there are certain very, very important judgments, and I will not take much time. There is a Columbia Asia, for example, head office rendering payroll or accounting services to all the branch. Please discuss that. So if any advance ruling is there, if you are a pan-India entity, whether you need to cross-charge these expenses from one branch to another or from head office to branch, it will not appear in your P&L. There is an advance ruling, it has been now upheld by the appellate authority for advance ruling also. Okay, and there is a good chance that the tax authorities will proceed against you if you are in a similar situation. Right? And it is a Karnataka-based judgment, so definitely jurisdictional authorities will not spare. The SSC is located, even though legally it is applicable only to that particular applicant, but it serves as a guidance for department to start issuing notices. So please ensure you have made all the official positions are taken as to what constitutes deemed supply, whether on stock transfer of services or inter-branch services or input service distribution, have I done it correctly, or inter-branch services, have I paid tax correctly or not. I mean, there could be many more such examples. Credit notes issued after the end of the financial year but reflected in the annual return. So there is a time limit for issue of a credit note. There is a section 34. There are certain conditions to be fulfilled. There is a GST credit note if you issue it within the year or within 6 months of the end of the year. So even after the end of the year, if you have issued a credit note and it is reflecting in the annual return, this is a proper reduction from your turnover as far as your audited balance sheet is concerned. Trade discounts are accounted for in the audited financial statement but are not permissible. So there could be certain discounts which are there in the balance sheet but they are not permissible under GST. Now I will not take much time again here. Discount is earlier under VAT law was allowed only if it was shown on the face of the invoice. But now if you read section 15, which is the valuation section of the GST Act, it says not only discount which is on the sale of the which is shown at the time of supply on the face of the invoice, post sale discount is also allowed. But that post sale discount comes with 3 very big conditions. If any one condition also if you don't fulfill, that post sale discount is not allowed. Any such type of discount which you have availed in your books of accounts but are not permissible under GST, there could be many more other type of discounts. Quantity discount, trade discount, cash discount, season discount, off-take discount, whatever. What is discount itself is a subject matter of huge discussion. So there could be certain discounts, if it is not allowed under the GST law, you have to add it back. Now, turnover for the first 3 months, obviously it will not form part of your turnover as per the GST return. Straight away, minus that. Now, is this turnover the normal sale turnover? You have to also look at point of taxation. So let's say point of taxation under VAT and service tax was accrual or receipt, whichever is earlier. In Karnataka, VAT section 7 was time of sale. It is either receipt of payment or transfer of or sale of goods, whichever is earlier is the point of taxation. Same thing in service tax law. So this turnover does not mean turnover as per the accounting standards. It is based on point of taxation as per the relevant laws under the VAT and service tax laws as determined, and which constitutes a turnover as per your audited balance sheet, also has to be deducted, and that has to be then deducted to arrive at the turnover as per your annual return. Obviously the first 3 months turnover, whether the normal or the turnover as defined under those laws, has to be deducted, to put it in a simple manner. Now again, unbilled revenue at the end of the financial year, for which I am going to do the billing next year, but booked as a sales this year, obviously that will not form part of my turnover in GST return, so that has to be minused. And adjusted advances at the beginning of the financial year, for which I would have paid tax on advance in the last year, will again not form part of the GST turnover in this year. Very important. This is a bit confusing. I also took some time to understand the unbilled revenue at the beginning and unadjusted advances at the end, and the mirror image of that in this clause. Be very careful. Extremely important. Credit notes which are accounted in the annual financial statements but which are not permissible under GST law. These are non-GST credit notes, financial credit notes. So there is a credit note which you can issue under the GST law whereby you show the amount of GST also in the credit note, right, which reduces your liability in the month in which you issue a credit note, subject to fulfilling those conditions. Now if you don't fulfill GST credit note conditions, nothing stops you from issuing a normal financial credit note to your customer, but in that you cannot show the tax amount, which means only the transaction value or the sale value can be deducted. That is the turnover, that is the credit note which has to be disclosed here, which has to be added back. So because this is not allowed as a reduction. So let's say there is a credit note on which has to be issued within 6 months of the end of the financial year. You are issuing that credit note after the end of more than 6 months of the end of the financial year. Let's say the 7th month. Those are some of the cases. Or the credit note which does not fit in the criteria of a particular credit note. Then adjustments on account of supply of goods by SEZ to DTA. Now SEZ itself is another area and ocean of practice. By and large, you know what is the meaning of SEZ? Special Economic Zone. It is a earmarked zone. EOU can be anywhere in India. EOU can be even in this premises, assuming it is a demarked area. But SE zone can be only in a specific zone which is notified by the government. EOU, it need not be that specific area, need not be demarked by the government, but yet you need a customs bonded warehouse license. So any sale by SEZ to DTA, there is a lot of confusion whether who should pay the tax, whether it is the SEZ unit should pay or DTA. DTA means domestic tariff area, which is outside the control of the Customs Act. It is like any other normal Indian unit, whereas SEZ is considered as deemed to be a foreign territory for the purpose of customs excise and GST laws as per the SEZ Act and rules. So if there is any supply of goods by SEZ to a DTA, it is generally the DTA buyer. He will file a bill of entry. For him it is an import of goods. The SEZ seller will not discharge as a seller. That is one of the exceptions, and it will be an IGST transaction. So it is the buyer of GST, buyer of goods from SEZ. Goods, again this is goods, not services. Supply by services or by SEZ to the buyer, there is a chance that the SEZ has to discharge. But goods and services operate differently when it comes to SEZ taxation. So when the SEZ sells goods to a buyer in India, SEZ is also physically in India, but it is deemed to be a foreign territory. It is the buyer who has to file the bill of entry, and he has to clear the goods, and he will pay the import duty or the IGST. SEZ does not have to discharge. So it may be that you are auditing an SEZ, it is disclosed as a turnover there, but that is not a turnover for your GST purposes. So adjustments on account of supply of goods by SEZ to DT unit, very very important. Turnover for the period under the composition scheme. Composition scheme, again section 10 is there. So basically for part of the period if you are a composite dealer, for other part of the period you are a normal dealer. For the part of the period for which you are a composition dealer, you have to exclude this particular turnover. Now, adjustments on account of valuation, section 15, very very important. I will not obviously get into that, there is a separate session only on valuation. So whatever the plus minus, please read the valuation section, it is extremely important. If you are a GST auditor, section 15 read with the valuation rules is of utmost importance. Then the next 2-3 is, N is adjustment in turnover due to foreign exchange fluctuations, that is again plus minus. Now 5O is very very important. What all reconciliations specifically are not reported earlier has to come here. Now for example, notice pay period. So there is an employee of your client who has left, and as per the employment contract, if he does not serve the full notice pay period, there will be some sort of a recovery by employer from employee's pay slip. Now there is some sort of a grey area whether this can be taxed or not. The service tax also we had. Now even GST, there are companies who are paying, there are companies who are not paying. Right? So it is a recovery, which means the employer is getting money, which means there is a deemed element of supply by employer to employee, not employee to employer. That is a salary, that is an employer-employer relation. So if you are recovering any notice pay, or if your supplier has paid you back, there are a lot of companies who reduce their expenditure. You don't show it separately as a turnover in your P&L account. It is those reconciliations which will come here. I mean, this is just one example, there could be 10 other examples, So your supplier giving you some sort of a rebate, you will go and reduce your expenditure. Okay, so you have to, so for you to report in 5O, you don't have to only audit the turnover, you have to closely audit the expenditure account. Any reduction from expenditure, if it constitutes a turnover for GST, has to find a place here. Very, very important. There are a lot of companies who reduce the expenditure. Fine, that is acceptable as per accounting standard, audit standard, statutory auditor will sign. But that recovery, either from employee or from supplier, could constitute a turnover for GST. So please be very, very careful when you are doing a kick-off meeting with your clients. Please ask them all this. Clients may not even know. There are clients where we have done the audit or done the compliance review, they are not even knowing. Because let's say the payroll is handled by the HR department, for example. You never know. So whatever the net salary figure, they always account it. But in that salary register, if you see, there is a notice pay recovery, there are 10,000 different type of recoveries. Recoveries towards canteen, rent a cab, insurance. There could be so many employee recoveries. Now whether employee's recovery is liable to tax or no, it's a separate area. There is a lot of litigation. There is a supply definition which is retrospectively amended. So you have to sit down with your client and see what is the legal position, if there is any employee recovery, especially in Bangalore, especially IT companies. This particular GST adjustment will be rampant. Okay, you have to sit with your client and understand what is the official position he wants to take, whether on any employee recovery. Is he going to discharge the GST and on what value? These two important things are there. And if required, let him go, and we have told to the clients, and clients have taken external legal opinions. Because client is not aware, he is new. We will tell him 4 case laws, client will obviously not agree, he may not even know. Then we will say, please take a legal opinion. So those will be again the discussions back and forth between the auditor and auditee. So what will come here in 5O is very, very subjective. According to you, legally it may be correct. Practically the client may not accept. There could be genuine no man's land. So this 5O will be very, very closely watched even by the tax authorities. Let me tell you that. So 5O is very, very important. If you are part of any audit, if there are a lot of adjustments in 5O, please sit with your manager and understand what are these adjustments. I think that is very, very important. I have just given you 1 or 2 examples, that could be n number of other type of cases for 5O adjustments. Then you arrive at the gross turnover after adjustment, compare it with the turnover. and reasons for, and then this throws up automatically. Now you just see, it has just taken me half an hour or maybe 20 minutes to explain, but in practical audit situations, if you are auditing a large listed company or a company having 5 GST numbers, you know the amount of work which is involved is not funny, let me tell you that. Till date, as I told you, the companies are grappling to give you state-wise sales reconciliation, forget purchase reconciliation. Now, the reasons for unreconciled differences, we have to disclose the reasons. All this was not there in any of the earlier audit reports, let me tell you that. Then, once you arrive, annual turnover after adjustments from 5P above, this is the gross turnover. From the gross turnover, you have to arrive at taxable turnover. Like in VAT, you have the gross turnover, apply deductions and come at the taxable turnover. So all exempt transactions, all nil-rated transaction, non-GST supply, no GST supply, exports, zero-rated, everything will be deducted from gross turnover, and then you arrive at the taxable turnover. And supplies on which your customer is supposed to pay reverse charge. Let's say you are a law firm or you are into sponsorship services. It is your receiver of those services which is liable to pay tax, or a GTA, goods transport agency. Then taxable turnover as per adjustments about taxable turnover as per liability declared in annual return. Very, very important. This will form the base for assessment, because the value on which you will apply the tax. Okay, so this is very, very important. And unreconciled taxable turnover. Let me tell you, the client would have disclosed all transactions. You also identified, but there may be a genuine difference in valuation. So only the valuation would be a subject matter of reconciliation here. He has disclosed everything. Let's say free issues by builder to a contractor, and if you are auditing on big contractor, whether that free issue, when he includes it in his contract and again resupplies, whether it has to be included, it depends on the wordings of the contract. I am just giving you an example. So extremely, extremely important, even the valuation provisions. Then reasons for unreconciled difference in taxable turnover. See what great length the law is going and telling you, give me each and every reason. So between 100 and 110, those 10 could be a sum of 20 different reasons. You have to highlight each of those reasons, which means now they are getting at a very, very granular level of reconciliation with your audited books of accounts. Extremely important. I mean, this is going to be very tough in the first year. Let me be very frank, for the auditor, for the auditing, and later even for the department. Because when the department audits you, finally you have to sit with them and make them understand. Extremely important. Then after reconciling the taxable turnovers, you have to also, now this is again one very, very important audit procedure. You have to reconcile the tax paid and tax payable as per your reconciliation differences rate wise, 5, 12, 18, 28, cess, forward charge, reverse charge, interest, penalty, वगैरह वगैरह वगैरह. Now one important audit procedure is not only to tally the turnover, there is something called output tax ledger account. In output tax there are 3 taxes, CGST, SGST, IGST for every state. Let me tell you, there are a number of companies who just have one tax account. If it is backed by detailed tax reports, which means that tax output tax payable, so whatever your turnover for a particular month, if you apply that rate of tax, 5, 12, 18 as the case may be, it should result in that gross output tax liability. So auditing the turnover and arriving at the output tax liability based on either the ERP system, or if the ERP system does not throw rate wise or tax wise, you have to insist on reports. It is ideal that you get rate wise output tax payable account the reports. Same thing for even input tax. Or if not for ITC, at least rate wise, because classification is something as an auditor you have to vouch for. Let me tell you, on purchase you don't have to comment on the classification because that is done by the supplier. It is not the buyer's obligation to audit whether my seller has supplied at the correct rate. But what I am selling, I should discharge correct rate of tax. Very, very important. So rate-wise output tax ledger should match with my total turnover. Very, very important. If the ERP does not throw up that, you have to insist from your client, please give me backup reports rate-wise on a test basis. Depending on the internal control system of the SSE, you have to apply that rate, and on a sample basis you have to check whether for these turnovers, if I apply 12%, is it recorded as an output tax liability? Very, very important. And those things you have to report here. Reconciliation of rate-wise. Let me tell you, it is a very, very onerous task. For forward charge, for reverse charge, for 3% jewelry rate, for 0.25%, for 0.1%, these are all that export concession rates of tax. Then for interest, late fee, penalty. So here it is, tax amount paid as declared in the annual return, tax amount to be paid as per the tables above, that is as per what auditor has checked, That you compare it with the tax payable rate wise as per the annual return. The difference you have to report it here. I mean nothing can be more than this. And the reasons, what reasoning you will give sometimes. You know? So, sorry. Unreconciled. And based on this, additional amount payable but not paid due to recent satisfaction. You know? So you have to report the reconciliation of turnover differences, you have to report the reconciliation of taxes and additional amount payable. Now this is a very dangerous column, table 11. The moment you say you report anything here, straight away there is a very high chance you are telling the tax officer, please come and audit this particular SSE. So this reporting here in 11 has to be done very, very carefully after exercising great due diligence and care and judgment and after agreeing with the auditing. I mean, see, I am not saying you compromise obviously on your professional risk, you have to balance your professional risk. At the same time, you make sure that you act as a business enabler along with the client and make a suitable disclosure. Because there could be so many things which you and your auditee will not agree. He will say, no, I have a different point of view, there is a different case law, you may have a different case law, So like for example, Giriraj Renewable, solar plant. Okay, there is one state which gave 5% ruling, Karnataka state gave I think 12 or 8% ruling. Later the appellate authority is held, it is a works contract services liable for 18%. Now client is saying, no, I will follow the Maharashtra advance ruling which is 5%. But you as an auditor will say, no, 18% held by Karnataka, upheld by AAAR. So that becomes a point of discussion or dispute between auditor and auditee. Like that there could be practically a lot of issues on a lot of practical and legal points. Now come to part 4, I will quickly go through this. Table number 12. This is on a holistic basis, not each expenditure wise. Reconciliation of the net input tax credit. So if you look at 12A, it is ITC availed as per the audited financials. ITC booked in earlier financial year, claimed in current financial year. Current financial year is 17-18 from July 17 to March 18. Here, whatever ITC booked in the earlier year, which means as on 30th June, whatever the TRAN credit was there, which you have transitioned into GST, that will be reported here. And in 12C, whatever ITC is booked in the current financial year, but for whatever reason you have claimed it in the next financial year, will be reported here. Then ITC availed as per audited financial statements. Okay, so this will throw up. Okay, A plus B minus C will throw up audited ITC as per audited financial statement. Compare it with ITC. This is on a total basis. This includes input services and capital goods, and this includes only eligible ITC. This should match with your 7J, J for Jaipur, 7J of annual return. Please make a note of it. If you get a chance, please have a look at 9 and my fellow speakers will dwell on it. This amount you have to straight away pick up from 7J, which is basically after prorating and disallowing all ineligible, this is the eligible credit as per GSTR 9. You have to report it here. And unreconciled ITC, reasons for that. Now, come to the most important part of this audit report. See what feedback we have got from the clients. Okay, fine. GST first year law, this, that. Sales we can still, reconcile. What they are finding it the most difficult is to expenditure wise to reconcile it with the audited financial. And that is where the maximum time will be spent. Till date, maybe some clients has given us sales reconciliation. Nobody has given us the expense reconciliation. In fact, if you see, most of the clients where we are auditing, they don't, lot of clients, they don't have any control over their monthly input tax credit. If you look at 3B, you have to disclose eligible and ineligible credits both. Practically how it is happening is, the client is tracking only eligible credits. Ineligible credits, he is expensing it off either on the rates and taxes account or with the respective expenditure account. Which means, let's say, canteen charges, if it is disallowed, he will, the GST suffered expense, 100 rupees including GST, he will pass it off. Or he will write it off. Or let's say GST is 10 rupees, expense is 90, 10 rupees he will disclose it on the rates and taxes for him to track separately, and only 90 rupees he will pass in the expense account. Different people are doing different way of accounting. Now here, if you look at the instruction to column number 14 of this particular thing, each and every GST suffered expense has to be reported here, whether it is eligible or not eligible. Mind you, this is not about what is eligible, what is not eligible. So 14 is a very, very big task. It's like climbing a Mount Everest. Okay. Now another practical thing for manufacturing companies, not for trading companies. I don't disclose purchases in my audited P&L. What I disclose is consumption or difference in opening and closing stock. So here you have to go into the backup workings of the client month-wise and determine he will have opening stock of raw materials, he will have closing stock of raw materials, he will have raw material consumption figure. The balancing figure will be raw material purchase. That ideally should tie up with your input tax credit month-wise of raw material purchase, local and imported. Can you imagine just for this line item 14 capital A, what is the level of work you have to do? Same way, freight, carriage, each and every GST suffered expense, you have to report it here. Value, what is the amount of ITC? Now this ITC is whether it is eligible or no. And this has to be disclosed by the SSE. The column number 4 on the right hand side, amount of eligible ITC availed. This has to be disclosed by the auditor based on his audit. The difference between 3 and 4 will be ineligible. Very, very important. And if you look at the instruction to this column number 14, these are only indicative. The SSE is free to add or delete any expenses. So this classification here may not be the same as the classification in your trial balance, right? You may have a different classification. You may have rental insurance as part of maybe conveyance charges or other charges. You know. So capital goods or capital expenditure will also come. So non-P&L items will also come here. Any other expense, 1 or 2. Other miscellaneous expenses. So what is miscellaneous for you may not be miscellaneous for me. Other general expenses, overhead. So, a lot of generic terminology is given here. By and large, each and every expense in your audited P&L and your balance sheet fixed asset schedule addition from 1st July 2017 to 31st March 2018 should come here. Based on that, you have to report what is the total amount of ITC availed. This is the auditor's job in R. ITC claimed in the annual return on a total basis. This is a culmination of all input services, capital goods, eligible credit, unreconciled ITC. Let me tell you boss, we are running against time. And the reasons and tax payable. Very, very important. Right now? Then the most important thing, part 5. And then I'll quickly get on to the last part of my session. Part 5 is to be paid through cash. So any liability determined during audit, it has to be paid only through cash. You can't use the input tax credit. Extremely important. It has a direct cash flow impact for your client, working capital. And one more important thing is, just look here. Part 5, row number 146. If you identify excess input credit, yes madam? If you identified excess input credit, can you reverse it? Ideally, if as an auditor you identify, you have to reverse it. This gentleman are telling to pay it in cash. So even though liability, output tax liability, not only that, if excess input credit is identified, you cannot reverse, you have to pay that excess input credit in cash. So input credit control is very, very important. I am telling you, it is the most important thing. Sales, by and large, clients will have a control because it is all linked to marketing, business people and all, nobody will mess around with the sales. Input credit, I have seen many very good, listed companies or manufacturing companies, they don't have a good control or a very, very basic level of control. So input tax credit auditing, monthly control sheets, monthly input tax register, is it tying up with 3B, is it tying up with GL, those are a must. And all that should be reflected in your 9. In fact, before you start auditing 9C, I feel your 60% of your audit should be complete at the time of verification of Form 9 itself. Because your 9 forms the basis of auditing 9C. And in your 9, all your month-wise input tax credit between the return and the GL duly reconciled should be disclosed in the 9. That's all. Now quickly I will just get on to the observations part. Slightly small. Now there are part B, there are two things. One is where I am the auditor of the company. I may be the GST auditor. Where I am not the auditor of the company and the client appoints me for GST audit. And there are some very intelligent questions in other forums. Can I be the GST auditor of only one state? Or if I am 10 states, can I be of 8 states and some other GST auditor of 2 states? Yes. There is no restriction of the law. We have clients like that. 5 states we are doing, 6 states some other auditor is doing. That decision is purely the client's decision. Okay. Now there are certain firms who don't take up GST audit if it is not an audit client. If it is not an audit client and if you are doing GST audit, okay, tax audit also you have 3CA and 3CB. 3CA where the audit is already done under Companies Act, 3CB reporting is where audit for that period is not done under any other law. You first do a financial audit, build up a financial statement, then you do a tax audit, right? In GST audit it is not like that. You don't first have to do any financial audit where you are not the auditor. I mean, these are all very, very important audit techniques and technical audit points. Okay. In 3CB reporting under tax audit, you have to first conduct a financial audit as a tax auditor. Then you have to conduct a tax audit. It is a double-decker audit. In GST audit, you have to only conduct the GST audit where you are the statutory auditor or whether you are not. It is just that wherever you are not the statutory auditor, you have to disclose that I am relying on the audit has been done by Messrs XYZ CFR. That's all. But what are the procedures to be performed if you are not the auditor? Can you rely? It may be the best auditor of the world. Certain things like internal control system, their accounting system, their payment system, that according to me you should yourself verify. Accounting, internal control, you have to make a note what are the inherent risks in any audit based on your evaluation of the internal control systems, and you have to document all that. Let it be, it may be a very reputed and a large audit firm, but nothing should stop you as a GST auditor if you are not the statutory auditor from, in a very basic way, re-evaluating. I am not saying you re-audit, you re-evaluate certain basic things. What is the system of ERP? What is the system of accounting, purchase and sale? What is the system of tracking input and output taxes, eligible, ineligible? What are the chances some things can go undetected? Right from a purchase order till the payment to the supplier, what are the accounting procedures? Right from the generation of a sales order till receipt of money from the debtor or the customer, what are the audit procedures? Please document. Based on that, arrive at your control assessment. Based on the internal control assessment, you have to design your audit procedure. These are all standard auditing techniques. Extremely, extremely important. Extremely important. And based on that, you have to report. By and large, the reporting is true and correct, not true and fair. So it follows from 3CD, from VAT to 40, same thing. Okay, you have to report. Now it is subject to following observation. Okay. And to the best of my knowledge, it is subject to following observations. Now, in what format you have to give your qualifications, observation, negative report, disclaimer, matter of emphasis, it is not prescribed here. In statutory audit, you have a CARO, right? Internal audit, obviously, it is a free-flowing format. There are companies where there is an internal audit format report also. Tax audit, there is a tax audit report format. VAT audit, we had a VAT audit report format. Okay, in VAT audit also, there were no, if we had additional observations and comments, there was no specific format. So we used to draft it in the free-flowing format. So in GST audit also, depending on the nature and size of the business of the company, okay, and subject to management agreeing and you having a proper sound management representation letter or a MR or management representation, you have to disclose in free-flowing language. Please refer either to the background material issued by the institute or to the guidance note issued by the institute. What language you should adopt. See, the basic format of the audit report is there. I as the auditor, I have checked everything. All that you have to follow as per the GST Act. But if I have any observations, which you will have, even in a mid-sized 50 crore turnover company, let me tell you, there will be some observations. Okay, let's say you identify certain tax. Client is saying, I will not pay interest. Let me get a notice. We are seeing these cases every day. Should you have to disclose it here? I don't know. I have also not yet decided. Fine, I am accepting the tax. I will not pay interest. I don't have money loss. Because the moment I pay tax, the interest meter stops. Unless there are provisions in the Act, interest on interest, then I will pay interest also. But I will not pay interest. So if I have not paid interest, do I need to disclose? Okay. Certain thing the client knows, but they don't like to admit, or the moment you say you disclose, it will invite a show cause notice. Client may agree with you. Okay. That yeah, it is payable, but he will put pressure on you. Please don't disclose. At that time, what is your auditor's responsibility? I am telling you that is going to be one of the most important things. So it is not going to be black and white, there are going to be greys, there are going to be shades of grey, light grey, medium grey and dark grey, within grey also. Because there could be legal points like employee recovery, client will say I have a legal opinion, please I will not pay. You can rely, then you can take a management representation if there is a genuine difference of legal interpretation issue. But if he does not take a legal opinion, on employee recovery. You will say, I have case laws as an auditor. Client will say, boss, I am willing to fight it out. Then what do you do as an auditor? He has not taken a legal opinion. Are you supposed to disclose it or no? You have an advance ruling in your favor. In your favor means which is against the SSE, but as an auditor, there is a tax exposure. What do you do? Questions are unanswered. Let me tell you that. If you talk to 10 auditors, 10 people will tell you 10 different things. We have to wait and see next 50 days what is going to happen. Because this is the first year of audit, lot of things are new. Even in VAT, we used to do disclosure, see, which is an upfront disclosure where the stakes are high. We used to also tell the client, and by and large clients used to agree. But where these medium cases are there, clients sometimes they also don't want to disclose. I'll tell you one example of entry tax. In VAT 240, you don't have to report about entry tax. Does it mean I go and say the client has not paid entry tax? Clients don't even know sometimes. Entry tax at 2% was applicable on import of machinery. Okay. So what we used to do is, we used to say, this report discloses only tax under VAT and GST Act and not other laws. What I am doing is I am protecting my professional risk. I am not going and complaining to the tax authorities that look, he has not paid entry tax. Because my report does not suggest entry tax, right? Simply why should I put what in the mouth of the tax, the lawmaker? So I used to disclose so that tomorrow the department should not say, why didn't you check entry tax? I will say I have disclosed it here. It includes only audit under VAT and GST Act, which means indirectly entry tax I have not checked, boss. This is one of the ways. So you have to, the way you word your audit report, it is the most difficult path to cross. From here to there, it is what, 30 yards. But it will be bigger than any of the audit period for which you have done. Let me tell you, the clients will come heavily. You will get a very major pushback from the clients. I am not saying all clients. There are clients who agree upfront, fine. But if there are a lot of legal issues, because the moment you disclose, surely they are going to get notices. Now, 2-3 other points and then I'll hand it over to my friend Chandrasekhar. There are 2-3 things. Are you supposed to check anti-profiteering? There are different views and I will request even Chandrasekhar to deal with it. My view is, if you look at the audit report format, audit report nowhere tells you please reconcile 2A 3B, please reconcile GSTR 1 e-way bill, please tell me about anti-profiteering. If you look at form 9, which only has to be filed by the SSE and the declaration has to be given only by the SSE and not by the auditor, he has to declare that he has met with the criteria of section 171, which is anti-profiteering. So it is his obligation. In form 9C, it nowhere talks about section 171. But yes, it would be a good audit practice, talk to the client and make a file note. But if you look at the definition of audit, 2 subsection 13, my first slide today, it includes not only examination of records and reporting turnover, taxes paid, input credit. You see the last line of 213. It includes compliances of the provisions of the Act and the rules made thereunder. That is where you can get possibly. That is where the regulator can come at you as the auditor and say, look, 171 is part of the provisions of the Act. Why didn't you check and report? That is still a grey area. Different auditors will give you a different feel of that. Same thing e-way bill. 2A 3B reconciliation is a classic case. 2A 3B will not reconcile. Let me tell you, it is the first time, and even though we had EU pass. So what do you do? The auditor or the client will come heavily upon you because for him it is a bottom line issue. Any reversal of ITC, it reduces his profits, right? It is a cost to him permanently. And businessman does not like loss of profit if you tell him. He will come down heavily upon you. There are people who have told us, look, I have complied with the provisions of section 16. I have received the goods, you said, right? I have paid, I have the invoice. Very correct. Why are you disallowing me just because my supplier is not uploaded? There are mismatch provisions. But clients are willing to take the call. There are clients who are willing to, they will say we will litigate. I don't care if my supplier is not uploaded. Why should I be penalized? So the last date for you to disclose ITC pertaining to 17-18 was March 3B return, 23rd April. Suppliers are not uploaded. The question is, are you as an auditor, can you accept that ITC which the client has captured in his 3B? Or you need to make a disclosure audit? Fine, you accept, but you need to make a disclosure because if you look at the extension removal of difficulty order 2 of 2018 dated 30th December or 31st December 2018, they say the section is subjecting to your 2A portal being showing this ITC, right? Please read these manuscripts. They have a direct impact on your audit. My friend sitting right there in that left hand side corner from here. Also, please read these manuscripts. They are going to be forming part of your GST audit file. What is the view the auditor should take? Frankly, even we are very, very difficult sometimes to come to the conclusion. Shall I disclose it? Fine, he has taken input credit as per section 16, but removal of difficulty orders is 2A portal. If I do that, I am effectively complaining about the SSE to the department. frankly, some of the answers even I don't like. So, friends, thanks a lot for a very, very patient hearing. These are some of the thoughts and more thoughts from Chandrasekhar. Thanks a lot and wish you all the best for your exams. Thank you very much.
Thank you so much, Madhur sir, for the wonderful session and focusing on the importance of the 9C. And now request Swarna Latana, Managing Committee Member, to honor sir with a token of gratitude. Thanks a lot, sir. We have arranged for some refreshments like tea, coffee and much more. You guys have 20 minutes of break. It's 11:50. You should be right back here by 12:10. 20 minutes break. Please make it fast. And the next session